Welcome to the IRS Debt and Audit Podcast with Brian Loughrin.
Hello, and welcome back to the IRS Debt and Audit Podcast with Brian Loughrin. Brian is a seasoned tax attorney based in Tampa and founder of TampaTaxRelief. For more than 25 years, he has helped individuals and business owners across the country resolve serious IRS problems, from audits to tax debts to cases in the U.S. tax court. I'm LeAnn Lyon, and today we are talking about how using multiple bank accounts can raise questions with the IRS and how that can affect a tax case. Hello, Brian. It's good to see you again.
Good to see you, LeAnn.
So, Brian, why does the IRS tend to pay closer attention when somebody is using multiple bank accounts?
Well, I like to point out a distinction. Most of our clients are either small business owners and or self-employed, probably maybe 90%. And so for most of them, they have a business bank account and a personal bank account. And when I say bank accounts, I mean primarily checking, not necessarily talking about some, money market accounts or even really a savings account per se, because most people can use a checking account for savings just as easily as for checking. So not many people that we come across have like dedicated savings accounts. But even understanding having maybe one business bank account, one personal or more, a lot of times what happens when people have multiple bank accounts, and especially when they have it at like maybe 3 or 4 different banks, I'll ask them, I'll say, well, you have one business and you do, shoe repair. Why do you have 4 business bank accounts at 4 different banks? And they'll say, gosh, I don't know. Maybe I opened it up because I got $200 to start a business checking account, or for a while I used it for something else that maybe wasn't business related. Then I put some business income there. I say it just sometimes gives the appearance, at least initially, especially in an audit situation, that people might be trying to hide something. And it's not that they are necessarily trying to hide, but coming into a situation, if the IRS looks at that, it's kind of a head scratcher. Why would you have 4 or 5 business accounts? Now, as to personal accounts, it's a little bit different. Husband and wife, they might each have their own checking account. They might have a checking account. For a lot of our clients have young adult kids that are college age, who are going away to school. They have a checking account for one of their children that they're on, that they can put money in. That's a little more understandable. But multiple business bank accounts, especially when you only have one business doing a particular type of industry, it's kind of a red flag.
Does the amount in those accounts have anything to do with it?
Well, that's interesting because somebody says, well, this account has, $1 million in it, and this account only has $10,000 or $1,000 in it. It's not necessarily the amount of money in the account. It's just if you're overstating the amount in one particular one. And again, that doesn't necessarily mean they're doing anything wrong, but it still begs the question, why would you keep so many accounts? Partly because most banks charge for business checking. There's still plenty of free checking out there with credit unions and things, but if you open up a dedicated business account, and that is really a good idea, because you have some different things that you can access in a business account, at least as far as records, that you don't always get with a personal account. It just begs the question, why would you be incurring those additional charges? Now, I will say in some cases, people have been in business for many years, and they look back and they go, gosh, I've had this account for 10 or 12 years. I just never closed it. That's fine. But if you overstate too much in one account and hardly have money in another account, it just doesn't seem to make sense.
When the IRS looks at these accounts together, what is it trying to sort out?
They're trying to sort out the flow of money, where it's going, where it's coming from, and which account it's going into. I'm thinking in these situations, you're really more in kind of an audit situation where the IRS comes in and says, look, we want to examine this tax return. And so they'll say, okay, what bank accounts do you have? Which is, we've talked in previous podcasts, that's the roadmap or blueprint the IRS uses, our bank accounts. And they'll say, well, you have money coming into this account, you have money coming into that account. Why would your accounts receivables not necessarily go all to one particular account? Now, keep in mind, we deal with small business owners, and that small business means $20 million a year or under in gross revenue. So we're not dealing with Fortune 50, Fortune 500 companies necessarily. And so the IRS will say, why would you not just direct your accounts receivables to come into one particular account? And again, sometimes it's because they have different people handling the money for a period of time, or they've changed out, accounts receivable or bookkeepers or things like that. But it definitely gives pause.
Can normal transfers between accounts be the impetus for some of that concern?
Yeah, especially when you have more than one business, and sometimes taxpayers will take a business that doesn't have as much revenue and try to take larger deductions with that over a business that has higher revenues, and they're transferring money between accounts and so forth. Here's what I tell my clients. Listen, there's times where maybe you have a couple businesses and one business is running low on working capital. They need that money in the account. And nowadays, so many organizations that businesses do business with, they want direct debits. The days of just sitting down with a stack of bills every month and writing out the checks on the 10th of those days are done. These direct debits are coming through left and right. So they'll keep an eye on their account and they'll say, I need to move some money from this business bank account to cover expenses to that bank account. And I had to do it because I didn't want things to bounce, or I didn't want my software service to get disconnected, or my electricity, etc. What I tell my clients is this: look, there's not necessarily anything wrong per se with doing that, but just keep a very clear record of doing that. Okay. And because so much of it's done electronically, the days of people getting in their car and driving to the bank, depositing a check or cashing a check and then driving to another bank, standing in line, depositing, those days are done. Everything is done electronically. So just keep good records, not just on the bank account, but keep a separate record. So that way, if you're, say, under examination, the IRS say, listen, I had to take $5,000 from this account and put it over here to cover these expenses, and then I paid the money back a week later or 2 weeks later and so forth. So just keeping good records on that in addition to the bank statements is really important.
What does it look like when the IRS starts piecing together income across multiple accounts?
It just depends how that income is flowing between the accounts. And in many cases, it's explainable. But here's the thing, if you're under examination or audit, that's a lot of work for the IRS to sort out. People say, well, who cares? I mean, they work for us and that's what they're there for and all that. And I say, well, I get all that. But think about it this way. If you're causing them all kind of extra work and extra steps and things like that, just to sort out something that could be more easily explained had you just kept better records, then you're just causing consternation that may or may not find its way into the final results. But it's just a situation where if you keep your records separate in addition to the bank statements, then it's going to be a lot easier to sort. And I will say this, people will come to me and they'll say, I'm under audit, or the IRS is wanting me to explain something, where this money came in or where it went. And I gave them my bank statements. And I said, well, the bank statements are not receipts. They're bank statements. So if you keep a separate record for that just internally, doesn't mean you necessarily have to put it with all your other books, but you can keep your own records, at least to the point where you can explain. And look, life gets busy and time goes on. If somebody's getting their business return under audit, it's not going to be the return they just filed 2 weeks ago. It's going to be a return from a couple years ago. And people are busy and they don't always remember things, exactly what happened.
Can you give us an example of what keeping a separate record might look like?
It's just something, maybe it's a spiral notebook or even QuickBooks, or just keeping a handwritten account of things, or just putting it on your computer in a Word document. But keep it near the bank statements as far as that goes, because it does explain not only where the money's coming in, but where it's going. Because the general rule is this for anybody in business. And it was one of the things I heard when I first started doing this work almost 20 years ago from an auditor. And we were sitting across his desk and I said something, and I don't know what I said that kind of made him sit back a little bit. He just leaned back and he looked at me and said, look, all we have to do is show income. The rest is up to the taxpayer. So if you have that income and you can't clearly explain how it may be used for business or where that money went in terms of it being a deduction, then you're subject to it being considered income and having to pay income tax on it. And that may not actually be accurate, but again, the burden then shifts to the taxpayer.
Can you tell us about co-mingling? What does it mean and how could that complicate things?
That's really one of the biggest things that people run into with multiple bank accounts is, or in many cases, a single bank account. And that's this: they have a particular account they've used maybe for a period of time, and they're starting in business. And so naturally, they use that account for business. And so essentially, it boils down to they maybe have one account, one checking account for their business and for their personal. I tell people, look, there's nothing illegal or wrong about it. It's just not a clean way of doing things, because you want to be able to have that bright line distinction. Going back to what I said just a moment ago, this auditor said to me, look, all we have to show is income. The rest is up to your client. So if you don't want to pay full boat income tax on everything your business takes in, and let's face it, no business is 100% profit, then you have to keep records, or you have to be able to provide that. So untangling and sorting out different things. Was that business? Was that personal? A good example is this: Amazon. I buy things for my business from Amazon. I use my business checking account to place that order. I also buy personal things from Amazon. I use my personal checking account. But if you just were to look at a bank statement, it would say Amazon, and the IRS, if to say they were looking at my business return, they'd say, well, how do we know you didn't buy laundry soap or whatever, movies or DVDs or what have you? How do we know you didn't do that? So obviously I keep the separate receipt from Amazon for business. And I don't even have a per se Amazon business account. You don't need to do that. I didn't see the need to set up a separate business account because I don't buy that much from Amazon for my business. But I do keep a clear record. But if I were to have done that with just one bank account, it's really difficult to extricate the differences. And why make it difficult for yourself? Forget about whether or not it's making it difficult for the IRS. Why make it difficult for yourself? You want to be able to just push that paper across the desk and it speak for itself.
Absolutely. Well, as we wrap up today's episode, when the IRS is reviewing multiple accounts, what tends to matter most in how they interpret what they are seeing?
Where the money came from. In other words, is it a source of income as opposed to maybe a loan or something? But more importantly, where did it go from there? So if it went between different bank accounts, what was the reason? And was it a business reason or personal reason? It's not even to an extent of where they think people are hiding money, because the bank statements do speak for themselves about money in, money out. It's just clarity in determining what might be a business expense, what might not be a business expense, and make it easy on yourself. If you do find yourself under examination for your business and or personal, and believe me, they go hand in hand, then you don't want to be paying income tax on something that is a legitimate business deduction. But if you don't have a way to substantiate it, that deduction may be disallowed, and that's no good.
As always, excellent information. Thank you. And that is it for today's episode of the IRS Debt and Audit Podcast. To learn more about Brian and his work helping individuals and business owners resolve serious tax problems, visit TampaTaxRelief.com. Thank you for listening, and remember to like, leave a review, and subscribe to the show so you catch every episode. Thank you, Brian.
Thank you.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.